Okay, I think we've got a few people in now. Do you want to kick
Yeah,
things off, Antonio?
yeah, for sure. So, good morning, everyone, and welcome to today's webinar about changes to the R&D scheme. My name is Antonio. I'm the marketing manager here at Apogee, and I'm very happy to be the coordinator of today's webinar, which hopefully will provide everyone joining us with valuable insights on changes to the scheme and what that means for your R&D claim as well. Just to keep the flow of the presentation going, I will kindly ask everyone to pop any questions in the chat, and at the end of this presentation, we'll allow some time to go through all your questions and cover as much as we can, and then obviously address any remaining question after the webinar as well. But before we dive into our agenda for the day, I just wanted to take a second to extend a warm welcome to everyone joining us today. Obviously, we appreciate it's a Tuesday morning. Everyone is very busy, so it means a lot for us that you are taking the time to jumping on this webinar today. Of course, with us, there's Jack. Jack is one of the directors and co-founder of Apogee. He's been involved in R&D tax credits for the best part of 6 years at this point. So he's definitely best placed to sort of, explain what the changes to the scheme are and what these mean for your claim going forwards. So let's have a look at the agenda for the day. So we will start with a quick overview of the R&D tax relief. So what it is, why the government is running it. We'll then touch upon some of the recent changes to the scheme. There'll be quite a few. We'll try to cover all of those in detail. And then we'll look at the new merged scheme, which is probably the focus of this presentation, and the ARIS scheme as well. And we will sort of look at the key differences between the new and old legislation. And like I said before, at the end, we'll allow a bit of time to go through any questions that you might have. But without further ado, I will pass it over to Jack to get started with the presentation, and I will be back at the end for questions.
No, thank you, Antonio, and thank you everyone for joining us this morning as well. I guess to kind of kick things off, just to give a bit of an overview as to what R&D tax relief actually is, for those of you that aren't, completely familiar with it, what that's looked like historically, which will kind of set a baseline for the rest of the presentation as well. So the R&D tax relief incentive was initially introduced in the year 2000 by HMRC as a way of promoting innovation in the UK and ultimately to stimulate the British economy as well. So HMRC conducted their own research some years back and figured out that for every £1 an innovative company that they give to an innovative company, the likelihood is that company is going to reinvest in innovation by an additional £1.50 to £2.30. So overarching logic is if you give an innovative company a chunk of money, likelihood is they're going to continue to innovate. And it's news to no one that innovative companies generally perform better. Often that leads to more profit, more job opportunities, and kind of all in all, more tax back to the exchequer. So ultimately, it does make sense for HMRC to give this money away. And fundamentally, it allows companies that are investing in innovative projects to receive tax relief on their associated expenditure. And this can be received in the form of a refund of corporation tax the company's already paid, as you're able to look at some of your prior financial periods, a reduction in future corporation tax, or as a cash credit. What that's kind of looked like historically, there's been two incentives. There's one for SMEs, which is companies that have under 500 employees, less than 100 million euro turnover, or less than 86 million euros on the balance sheet. And historically, this has been the more generous of the two incentives. So before April 2023, companies that met this criteria could expect to get back around about 19% to 33% of their qualifying expenditure. So what they've spent on R&D related activities. However, after April 2023, with some of the recent changes, that did become slightly less generous, and that benefit range reduced to 8.6 to 27%. And where a company sits on that scale, it's completely contingent on their tax position as a company. So whether they're profitable, loss making, around about break even. And with the more recent changes, so the post-April 23 benefit range, whether a company is considered R&D intensive by HMRC also factors into that calculation. And I won't dig into that too much now because there is quite a few slides on that a little bit later on. Simultaneously, there was also the RDEC incentive. So more often than not used by large companies that exceeded that SME threshold, but was also used by SMEs that received other forms of notified state aid. So grant funding was, the most common form here. Because the SME incentive was also a form of notified state aid, and one project is only able to receive one form to fund it. A company wasn't able to receive a grant and also recover their costs through the SME incentive as well. So the benefit range was slightly different through the RDEC incentive. Pre-April, the tax credit rate was 13%. However, as it was an above the line credit, this was taxed at the corporation tax rate. So before April 2023, the net benefit a company could expect to receive through the RDEC incentive was around about 10.5%. Whereas after April 2023, that credit rate increased to 20%, again, subject to corporation tax rate. So the net benefit was somewhere between 15% to 16.2%. And in terms of kind of what companies could actually or can actually qualify for R&D tax relief, HMRC have set out 4 key criteria to qualify a company. First of which is the company must be seeking an advance in science or technology. So they've got to be trying to do something a little bit different, a little bit better compared to the state of technology already available in their sector. There's got to be technical uncertainty associated with the project. So the best way to think about this is if from the outset of the project, you're not quite sure how to get to the end result. Perhaps you can get there, but you're not quite sure on the exact solution. So there's maybe trial and error, prototyping, iteration, testing. That's always a really good indicator that technical uncertainty was present. Third, a company's actually got to try and overcome that technical uncertainty. So you've got to do more than just think about it. Basically, you've got to spend time, money, resources on the project in order to recover those costs. And finally, the solution can't be readily deducible by a competent professional in the field. So it is important that competent professionals, relevant to the project, are working on the project. So the individuals with relevant experience, perhaps relevant qualifications, and if they, weren't able to come in and easily come up with a solution to the issue, then that final box is checked as well. So yeah, I mean, there's been quite a few changes to the R&D incentive for a number of years now. I think the more significant ones have certainly been over the past few months, but the changes really started to, be present since as early as April 2021. And as I said, I think that's culminated with the introduction of the Merged scheme and the ERIS scheme as of April 24, so a few months ago. And the general feedback we've got at Apogee is so much has gone on. People have really struggled to keep on top of it when these different changes affect people based on when the expenditures incurred. Is it related to a financial period instead? And I guess the purpose of this presentation is really to consolidate all this information and try and make it more digestible for people that aren't involved in this on a day-to-day basis. But in summary, I think HMRC have tried to introduce these changes to reduce the amount of erroneous applications, clear up their stance on certain relationships. So subcontractor relationships has been a big one, and in general, simplify the R&D tax relief mechanism. I still think there's a bit to go before that true simplification will really be realized. But I definitely think some good initial steps have been made. So like I said, the initial changes start dating back to April 2021, and this was in the form of the introduction of the PAYE cap. And this was basically set up to stop shell companies taking advantage of the R&D incentive by incurring costs in a UK company, recovering them through the generous R&D scheme, and then usually moving those funds to a parent, again, usually offshore entity as well. So this was introduced to try and eliminate that. And the cap is basically sets to the maximum credit, a cash credit a company can receive for loss-making companies is £20,000 plus 300% of the PAYE and national insurance and NIC liability of that company. There were some exceptions associated with this as well. So if the company was preparing IP in the country, if there was, if there was a threshold of expenditure that could be spent with partner companies. So a lot of our clients that we've worked with on this, where in theory they were in a position they could be subject to the PAYE cap, because of the way the company is structured, where the IP is being managed, they're actually exempt from that. So it's certainly it's a good introduction in terms of compliance, trying to do what the R&D scheme was initially designed to do, but it is something to bear in mind, and something that needs to be navigated quite carefully as well. So moving to April 2023, this is kind of split into a few sections, in the sense that there are some changes which related to expenditure incurred after the 1st of April 2023, and some which related to accounting periods starting after April 2023. And we've tried to split it up here as well. So the main changes for expenditure incurred after April 2023 was mainly to do with the new R&D rate. So kind of what I ran through on the last slide, slightly less generous for companies applying through the SME scheme, and slightly more generous for companies applying through the RDEC incentive. This also introduced that concept of an SME, an R&D intensive business as well, where there have been some more recent changes, which I'll dig into a little bit later on. However, for accounting periods starting on or after the 1st of April 2023, there were some additional rules and requirements brought in as well, including the introduction of the advanced notification form. Now, we're starting to see some people nearly get caught out by this, so it is a really important thing to bear in mind. And essentially what this is designed to do is pre-notify HMRC of a company's intent to claim. So it's very relevant for first-time claimants. It's also relevant for companies that haven't claimed in 3 years as well. What a company needs to do is essentially let HMRC know of their intent to claim for a financial period within 6 months of that year end. So it's certainly worth knowing, as a lot of companies often seek to do a 2-year retrospective application. And we have seen a couple of instances where companies have nearly missed out on this, or will nearly miss out on this, because they weren't aware of this, the advanced notification requirement from HMRC now. There've also been an introduction of new qualifying expenditure categories. Data, cloud computing are the big ones, which was very welcome news to a lot of our clients. I think with the nature of R&D, a lot of R&D being done in the country, data and cloud computing can amount to a huge cost of a project, and the introduction of those cost categories have been very welcome news to companies, particularly in the tech and startup space as well. And the general definition of R&D has been slightly broadened as well to include advances in mathematics. It's a very nuanced, very niche area, but it is certainly something that has enabled companies previously unable to claim for certain projects now be able to do so. And I think a lot of people will be somewhat familiar with this at this point. The additional information form has been a requirement since August 2023. And basically, this is some documentation that needs to go in ahead of an R&D application. Um, we have heard of instances where companies have tried to submit an R&D claim without putting in their additional information form, and unfortunately, HMRC's stance on this is that they will just outright reject the claim. So it needs to go in ahead of an R&D application, provide an overview of the advances sought, the technical uncertainty, the timeline of the project, and the costs associated with the project as well. And it's also worth noting that one of these needs to be submitted for each accounting period a company is seeking to claim for. I don't want to go into too much detail on this because we have quite a few slides on each point here. But for accounting periods starting on or after the 1st of April 24, the merge scheme, it has come into place. R&D intensive support for SMEs has changed slightly, and there has also been a restriction on some overseas expenditure. So the merge scheme, fundamentally, it's going to replace the SME and RDEC schemes. It's going to enable all companies of all sizes to access relief in a simplified, unified manner, where the treatment of subcontractors is consistent regardless of company size. The recovery rate or the way the recovery is calculated is consistent as well. And again, the same with the treatment of subsidies and grant-funded expenditure as well. However, it will be modeled on the RDEC incentive. So it will be an above-the-line credit, recognized as pre-tax income. So it will be subject to corporation tax. So although the benefit is a 20% credit above the line, the net benefit a company can expect to receive is between 15 to 16.2% of the amount of money they've spent on R&D. And that is slightly different for the ERIS scheme as well, but I'll come on to that shortly. And again, that amount can either be offset against the tax liability or received as a payment into the business. And I guess the overarching thing here is the definition of R&D for tax purposes hasn't actually changed. So a company still needs to seek that advance. That technical uncertainty has to be present, and there has to be competent professionals working on the project to try and overcome those uncertainties. So just to dig into a bit more detail, most qualifying categories remain the same. However, subcontractor costs have now been pulled into this, what is effectively a scheme modeled on the RDEC. So historically, large companies claiming through RDEC were limited in which subcontractors they could include as part of their R&D claim. It was limited to individuals, research organizations, universities, charities, but they weren't able to contract out work to another limited company, for example, or at the very least not be able to include those costs as part of their R&D claim. However, the merge of the schemes has basically removed that, and large companies, and companies who would historically have had to apply through the RDEC incentive are now able to include those costs as part of their R&D application. And many of the conditions and criteria for R&D tax relief, as we know it, has remained consistent. So a company needs to be subject to pay corporation tax in order to qualify. It doesn't necessarily need to be paying corporation tax, so it can be loss-making, it can be profitable, it can be around about break-even, but providing they are eligible to pay corporation tax, there is a possibility they could submit an R&D claim. The company also needs to be a going concern at the time the application is put into HMRC. The projects in which the company is claiming for needs to be relevant to the trade that company normally operates in. Revenue expenditure needs to have been spent on the R&D projects. So any cost flowing through the profit and loss account is what we will be able to look at. So this could be staff on payroll, subcontractor costs, materials and consumables, or software costs as well. And yeah, it still needs to be the pre-notification rules still need to be acknowledged, and companies will still be subject to the PAYE cap if they kind of fall within that area. So yeah, I think earlier I obviously alluded to some slight changes in SME intensity or R&D intensity. Initially, this was introduced, or the concept of an R&D intensive business was introduced in the spring statement in 2023. And the idea was to try and give companies who are more heavily invested in R&D greater support. So initially, when this was announced in the spring statement, the definition of an R&D intensive was that 40% of a company's total expenditure must be spent on eligible R&D projects. However, with the introduction of the Merged scheme and the ERIS scheme, that threshold has reduced slightly to 30%. So just despite some of the more significant changes recently, the introduction of the Merged scheme, this will continue, but is going to be referred to as the Enhanced R&D Intensive Support from now on, hence the abbreviation to ERIS. So yeah, it's, HMRC are still trying to promote that additional support for those R&D intensive businesses. So who actually qualifies to apply under the ERIS scheme? There are a few key things to be aware of here. The company has to be an SME, and that is an SME under the old definition of SME for R&D purposes. I know HMRC and the government have a few definitions of SME depending on where you look, but it is in this instance under the old R&D definition as well. The company has to be loss making. That point's quite clear. And the company's R&D expenditure must be greater than 30% of their total expenditure as a business. So just as a reminder of what an SME is in this instance, the company must have fewer than 500 staff and a turnover of less than 100 million euros on the 100 million euros, or have less than an 86 million of total assets on the balance sheet. So, generally, I think this is designed to be targeting those companies in the startup space, in the tech space, which isn't overly surprising, because I think that those companies are the most likely to be reinvesting in innovation, and that is, ultimately that's probably going to stimulate the British economy greater in the long run, which is the ultimate objective of the R&D incentive. So what does that actually look like in terms of what companies get back into their business through the various incentives, and kind of how has that evolved over the past few years as well? So starting with expenditure that was incurred before the 1st of April 2023, SMEs could expect, or companies applying through the SME incentive could expect to get back between roughly 18% to 33% of their qualifying expenditure, what they've spent on R&D, whereas companies applying through the RDEC incentive, net after tax, could expect to get back around about 10.5%. Looking at the updated rates, so expenditure after the 1st of April 2023, but before the introduction of the new schemes, SMEs could expect to get back between 8.6 to 21.5%, unless they were considered R&D intensive, in which case they could get back between roughly 12.5 to roughly 27% of their qualifying expenditure. And large companies could get back between 15 to 16.2% of their qualifying expenditure. So moving into the ERIS and the Merged scheme rates, I think you can kind of see there has been some simplification, consolidation of the rates companies can expect to receive, particularly with non-R&D intensive businesses. So regardless of size, industry, nature of the projects, a company can always expect to get back between 15% to 16.2% of their qualifying expenditure. However, if a company is considered R&D intensive, there is the option to apply through the ERIS scheme. And in that case, a company could expect to get back between 12.5-ish% up to 27%. So in summary, the benefit of the SME scheme has broadly decreased over the past few years, whilst it has increased slightly for large businesses. And I guess the one thing that's probably quite glaring there is, and worth bearing in mind going forwards as well, there are actually some instances where a company applying through the ERIS scheme, or eligible to apply through the ERIS scheme, won't actually be receiving the best recovery if they are to do so. And there is the option for a company to either apply through the Merged or the ERIS scheme. And this is completely contingent on the company's tax position, their profitability relative to their qualifying expenditure. So it's hard to give a definitive answer right now as to whether it makes sense for a company to go through the merge scheme or the ERIS scheme. But I think what's best to do is when a company has compiled their R&D application, they have their expenditure identified. It's good to work with your R&D provider or your accountant to figure out which scheme is best for you to go to apply through. Because there are those two options, and it isn't necessarily always going to be the ERIS scheme. So what are the key differences between the new incentives, the merge scheme, the ERIS scheme, and the old incentives? Well, I think the three key ones are initially subcontractors, how grant funding and subsidized expenditure is treated, and the restriction on overseas expenditure. So starting with subcontractors, HMRC have clarified who has been able to claim within a subcontractor relationship. Previously, there was quite a lot of confusion about who could claim from claimants. So generally, HMRC took the stance that you just couldn't claim for any work contracted to you. However, they have since updated their position. And ultimately they're saying the claim lies with the company that decides to undertake the R&D. So that approach applies both for the merge scheme and the ERIS scheme. And again, it using the same logic as has been the case historically. The costs are capped at 65% for unconnected subcontractors, or up to 100% of those costs can be included for connected subcontractors. And just to provide a bit of clarity on that, a connected subcontractor is someone or a company which has perhaps shared ownership, shared directorship, and in those instances, you're able to include up to 100% of the subcontractor's costs. But the amount you can actually include is the lower of either the actual cost of development for the subcontractor or the invoice amount between the two companies. And yeah, like I said, there is that restriction on subcontractor costs where activity takes place abroad. And there are some exceptions to that, which I'll come on to shortly as well. So we've put together a few examples of what companies can claim based on HMRC's new position. So in the example here, Company A has contracted out an R&D project to Company B. So the contract they issued, it involved R&D. Company A knew R&D was necessary. And as a result, it was their decision to undertake the R&D. So the project was clearly defined. They knew exactly what they wanted to achieve, and there was no ambiguity in the contract. So in this instance, Company A are able to submit an R&D claim for this project where Company B is not. An example of this could be Company A needs Company B to develop an advanced electronic system. It needs to meet very specific requirements, design as laid out by Company A. Whereas on the flip side, in the second example, Company A has issued a routine contract to Company B, which can often be fulfilled using routine industry standard methodology. However, in this instance, Company B has invested to invest their own time, their own money to develop something new and better. So ultimately, it was their decision. Company A hasn't asked them to do this, but Company B thought there was a better way of fulfilling this piece of work. So an example for this could be perhaps Company A contracted out a series of components to have a finish applied to them. There is an industry standard process, but Company B thought there would be a quicker, more efficient way of finishing these products. Maybe they wanted to engage in this project because there was because of the order quantity they received. I mean, the reasoning doesn't really matter. It's the fact that Company B undertook this R&D project off their own back, which is why they are able to submit the R&D claim. Now, there are instances where that's not the case, and even if the R&D project is defined by the initial organization, the second company, the subcontractor, can still claim for those costs. And the only real instance where this is possible is if there is no mechanism for the initial company to submit an R&D claim. So the R&D contract was there. The initial organization knew R&D was necessary, but because they might be an overseas company, a charity, a university, any other company not subject to corporation tax, then there was no mechanism for them to recover the R&D costs. Therefore, company B is able to submit an R&D claim in this instance. And finally, there's this kind of a hybrid scenario as well, where, and I guess just using the two examples as a baseline for this, maybe company A contracted out part R&D work for a project, part routine work as well, to company B. So maybe company B fulfilled their contractual part of the R&D project, where company A is able to recover those costs. But there was also an element of routine work there as well. And company B thought there was a better way to do it, off their own steam, through their own resources, undertook an R&D project to develop an advanced process that met the definition of R&D for tax purposes. So yeah, I mean, before the merge scheme, it didn't actually matter where subcontractors were located. They could be UK based, they could be based overseas. However, from the 1st of April 2024, there has been restrictions put in place for this. And only costs associated with subcontractors and externally provided workers undertaking R&D activities in the UK will be eligible. And those those restrictions apply to both the merged and the ERIS schemes as well. There are some restrictions to this where if it were deemed wholly unreasonable for the claimant company to carry out the R&D activities in the UK or replicate the conditions necessary, then overseas subcontractors can still be included in the R&D claim. So those exemptions are: the conditions aren't present in the UK, they are present elsewhere, and it would be wholly unreasonable to replicate them in the UK, as I mentioned. So to give a couple of examples that HMRC have laid out, things they would consider a valid condition in which the cost could be included, subcontractor cost could be included in the claim, as if there were geographical reasons. So perhaps there was a disease with no prevalence in the UK, required a clinical trial to be undertaken outside the country. Therefore an organization in another country needed to be contracted to undertake the clinical trials. That would be considered a geographical reason. So environmental reasons are also a factor here. So perhaps an R&D project necessitated the collection of samples of a newly identified plant species to assess their medicinal properties. If the plant is not present in the UK, but it is present in another country, it would be considered a valid exemption to contract a company overseas to collect those samples. And obviously, it would be wholly unreasonable to replicate those conditions in the UK as well. Social reasons are another valid exemption as well. So we've got a construction example here. If a company is developing a prefabricated wall panel for an overseas market which has different regulatory requirements, building standards to that in the UK, it's likely that a company in that country will need to be contracted to assess the viability of constructing that prefabricated wall in situ. Again, completely unreasonable to replicate those conditions in the UK. So that would be a valid exemption. And then finally, we've got legal and regulatory exemptions as well. So if a company, for example, is developing a piece of software for banking in the US, the development would likely require a team in the US, to have for access requirements to be able to access the banking sector in the UK. So again, there's quite a few reasons why, quite a few exemptions for the overseas restrictions. But I think fundamentally what it's trying to avoid is companies seeking cheaper labour overseas. And I think, as it's there on the flip side, cost and availability of workers are the two key things that HMRC are trying to avoid here. So grant funding and subsidized expenditure has been a huge change, and quite a positive one for a lot of companies as well. So previously, companies could not use more than one form of notified state aid on a project. And as the SME, incentive and grant funding are both, or most grant funding is considered forms of notified state aid. A company that did receive a grant for a project was not able to recover their costs under the SME incentive. So as such, grant funding had a massive impact on the ability for companies to claim under this scheme. So if notified state aid was received at any point in a project, all of those costs would subsequently need to be recovered under what was historically less generous RDEC incentive. However, there were instances where other forms of state aid it could have been received. Maybe it was a de minimis grant. In those instances, the grant-funded part of the project could be recovered under RDEC, whereas the remaining costs associated with that project could be recovered under the SME scheme. However, all of that has now changed, and in summary, there are now no restrictions associated with grant funding or subsidized expenditure. So the type of grants or its amount will not affect R&D claims. And it applies for grants, subsidies, where another company may have met part of the project's costs. Regardless of how the project is funded, all of the costs can be recovered under the merged or ERIS scheme. And I think it's all part of trying to simplify the rules and avoid any erroneous applications for applicants. So yeah, despite the simplification of the incentive, for the time being, there is going to be 4 incentives that people need to worry about, and there will be for the foreseeable as well. So for accounting periods starting prior to the 1st of April 2024, companies will need to be making use of the SME and RDEC incentives, which has obviously been in place for quite a while, and people are quite familiar with. However, for any accounting period starting after the 1st of April 2024, the merged scheme, RDEC, and the ERIS scheme needs to be taken into account. So what that looks like in practice is, we're actually going to be looking at 4 R&D incentives to manage and keep in mind and apply in various situations up until the 28th of February 2027. Now, this is the case because companies can obviously retrospectively claim for their 2 prior financial periods. So even at the 28th of February 2027, in theory, an R&D application can be submitted until for the period ending 28th of February 2025. So despite the long-term simplification, I guess, for the time being, there's quite a lot to bear in mind in terms of the new merge schemes, the old schemes, and indeed the different rates amongst that as well, over depending on when the expenditure was incurred. So if there's any kind of uncertainty around, what incentives to apply for, what recovery rates relate to expenditure for, certain projects, depending on when it was incurred, I always think it's best to get in touch with an R&D provider or even your accountant for a bit more guidance on that. So I think I've pretty much covered everything off there. I think I'll hand back over to Antonio for questions. But yeah, I think he's been keeping monitor of what you guys have been putting in. But yeah, it's been a pleasure having you all here. Thank you for taking the time to listen to me for the last 30, 40 minutes. And yeah, please fire away if you do have any questions.
Well, thank you very much, Jack. That was very insightful. And yeah, you cover everything in great details as well. I think we have a question in the chat, well, a couple of questions. So starting with the first one, someone is asking, are there differences in the application procedure of the Merged R&D scheme and the ERIS scheme? And in other words, do you need to decide which scheme are you applying to before you start your application?
So you don't need to decide before you start your application. The compilation process is very similar in terms of you need to pick out which projects qualify, which costs are associated with that project as well. It will be at the point of submission with the CT600 and the tax computation that that decision can be made as to whether it's going to be through the merge scheme or through the ERIS scheme. And like I said, I think it's at that point when you have identified your expenditure and you know what your tax position is at the point of submitting your CT600 that will be best to make that decision. Um, so you know when it comes to that point and you've got all your documentation ready and you want some advice on which route to go down, I think it's probably best asking either an R&D consultancy, the one you're working with, or your accountant, as they will be in a really good position to advise which incentive will be best for you.
Yeah, I think that answered the question. So the next one is from someone who runs an SME business and believe that they could potentially fall under the ERIS scheme because they invest quite regularly in R&D projects. So the question is, how can I establish whether or not I should be claiming under the ERIS scheme?
So to be eligible for the ERIS scheme, you have to be an SME for starters, a loss-making SME, and your total expenditure into R&D has to be at least 30% of your total expenditure as a business. So if you meet those three criteria, you're in a position where you can choose to either submit a claim through the ERIS scheme or the merge scheme.
Brilliant. So another question is around the merge scheme, and is under the merge scheme, can I still claim for my last 2 financial years?
Yes, yeah, you can. So the one thing I'll say to bear in mind there is it is still subject to the pre-notification rules. So if you're a first-time claimant, you will need to let HMRC know of your intention to claim for that first period 6 months after that year end. And then obviously if you were looking to do a 2-year retrospective claim, you wouldn't then put that together for another few months or so. And lots of people choose to do that because it's particularly if you're doing it internally, compiling an R&D report can be quite a time-intensive exercise. So yeah, I guess the one thing to bear in mind is if that is your intention, just make sure you've marked in your calendar that you need to pre-notify HMRC, you know, well in advance of when you actually look to compile the report. And the pre-notification process isn't overly time-consuming or onerous. It's basically a very brief description of the project you're intending to undertake or the project you're intending to undertake. So a lot of companies can do that internally. Equally, R&D providers, us as well, we're happy to you know to support and guide through that. Although it is by no means as onerous as compiling a total R&D application.
Well, thank you very much, Jack. So we have another question around overseas subcontractor expenses. So the question is, when do the change to the overseas subcontractor expenses come into effect?
So that has come into effect now. So as of the 1st of April 2024, it was initially planned for the 1st of April 2023, but they pushed that back by a year because there was quite a lot of pushback from claimant companies, and to be honest, there still is. But I think the logic from HMRC is they want to try and keep innovation within the UK, try and encourage UK companies to work with one another. But those changes have come into effect now.
And the last question is if everyone will receive oh no, we've got another one that just popped in the chat. But one of the other questions is everyone receiving a spare copy of this presentation after the event has finished? Yes, we will send that out to everyone. We'll send out a guide on R&D tax credits as well to everyone. So yeah, don't worry, you will receive a copy of the presentation after the event. we have another question. Does the pre-notification need to be done every time, or it is only for the first time?
I guess it depends on how frequently you're submitting an R&D claim. So it needs to be done for first-time claimants now, but also for companies that haven't submitted an R&D claim in 3 years. So lots of the companies we work with do submit annual R&D applications, but there are instances where some of our clients, their R&D projects are more disparate. And I think that's just something to bear in mind. If you're not submitting an R&D claim every year, um, it's definitely worth having in the back of your mind that you might need to submit a pre-notification form again, just to let HMRC know that you are intending to claim again, and what kind of project you're intending to claim for.
Okay, great. I think that answers the last question, but yeah, if there is any other question, feel free to pop in the chat. If you have any questions at later stages, please let us know. Just fire over an email. More than happy to address any questions or concerns on the new merge scheme at any point.
Brilliant. No, and I just thank you from me as well, everyone. Thank you for joining, and we'll get everything sent over to you later today. And if you have any questions, feel free to send me an email directly. It's jack@apogee.co.uk. Yeah, either happy to answer any quick questions or jump on a quick call to discuss your specific requirements or questions.
Excellent. Okay, thank you very much, everyone. Thank you for joining, and yeah, to the next one, I
Brilliant.
guess.
Fantastic. See you later, everyone. Bye bye.
Bye. Bye. Bye.